Finance is part of almost every endeavor in the modern world, from choosing where to go on holiday, to what job to take, to where we do our daily shopping. Little in our modern world would be possible without finance. No functioning companies, no shops, no factories, no products. One just has to look at a nation with hyperinflation to see that without finance, much of human coordination dries up and ceases to exist. Over the course of thousands of years, our global financial system has evolved to become an extraordinarily complex system, a multiplicity of overlapping networks that move trillions of dollars a day and serve billions of people, enabling them to make purchases, invest their savings, and trade with each other. But for all of its great achievements, behind the scenes, our industrial age financial system is not feeling so well. It's a machine of incredible complexity that makes it slow, expensive, lacking in transparency, and is thus prone to fraud. It promotes speculation and instability, and it seems to create dangerous concentrations of wealth that leave societies divided. It begs the question, what would a functional financial system look like that is normalized for an age of information, globalization, and works for the economy and society? In our paper on financial systems innovation, we trace out the past, present, and future of the financial system in an attempt to answer this question. Financial systems are the information layer that records and mediates economic activity. Finance serves the function of accounting for and exchanging economic value. Financial systems allow funds to be stored and moved between economic actors. They enable individuals and organizations to share and exchange ownership with the associated risks and returns. Over the course of history, the specific financial institutions through which this has been realized have taken many forms. In the past centuries, the world has gone from a pre modern, community based financial system to an industrial age centralized system, to today, where we are building new forms of global financial institutions based wholly upon information technology. Our modern financial systems were born out of the coalescence of new innovations in record keeping, in the form of double entry accounting, the formation of the new political unit of the nation state, and their single common economic systems that spanned over a relatively large geographic area. The new economic model of capitalism that was specifically designed to create large financial accumulations, while large investments in industrial infrastructure required ever greater and more sophisticated institutions for the amassing, storing, investment, and exchange of financial assets. With industrialization, our systems of organization went from the local and regional level to the national level. In this context, small local community banks no longer sufficed as a centralized national banking system came to dominate. As large industrial installations require the concentration of large capital investment, centralized national banks were really driving forces in the expansion of capitalist economies over the course of the past centuries. During the 20th century, the banking system made many innovations to serve customers better and move money more efficiently. From the swift interbank exchange system to ATMs, credit cards, and online banking, huge improvements in financial services were made. With the confluence of major trends in the late 20th century, from financial deregulation and globalization to the rise of information technology and financialization, the financial system changed hugely within the space of a few decades. It expanded to become a global system, managing vast flows of capital, organizing the cross linkages of assets and liabilities that interconnect people and organizations around the planet. It is now difficult for us to imagine that as little as 40 years ago, banks were just banks, as within the space of these years, fueled by information technology, financialization has become an all pervasive force in our world. Although with globalization and information technology, the system has expanded in scope as more and more spheres of economy and society have become financialized through a veritable explosion of financial instruments. The system is today prevalent with issues that create many negative externalities for society and economy. Information technology has worked to make the system increasingly abstract through the creation of ever more complex derivatives and structured products, with a growing disconnect between finance and economy and society. Today, only a small fraction of financial flows coming out of the largest financial institutions are going back for investment in real economic activity. The end of industrialization and the expansion of financial products makes it simply much more lucrative to create new kinds of financial products and speculate than invest in the real economy. This disconnect in speculation makes the system inherently unstable and prone to collapse, which is externally highly costly to the economy at large. Barterman and Bodnar estimated the financial crisis destroyed asset values equal to 50% of world GDP at that time. As the system has scaled, its centralized architecture has worked to make it overbearingly complicated internally. Behind the digital facade of online banking and mobile apps, banks and insurance companies are overloaded in paperwork, while layers of intermediaries, each charging their own transaction fees, make it cost ineffective. These high overhead costs make the system exclusionary, denying billions of people access to basic financial tools. The inherent closed and centralized nature to the system means that it lacks transparency, which breeds crime and abuse of trust. As PwC reports, 45% of financial services suffer from economic crimes every year. Since the financial crisis, the banking industry has largely declared ethical bankruptcy at the expense of a huge loss of societal trust and the many billions of dollars paid each year for misconduct. Today, the world is in an unparalleled technological revolution. Question is, could such world-moving transformations in society, economy, and technology largely leave the financial system unchanged structurally? It seems unlikely. Historically, as technology evolved, the financial industry has been reasonably good at integrating those new technologies in order to better serve customers. But this changed during the financial crisis as banks were busy dealing with the numerous new rules and regulations. Given the rapid rise of the web at that time, there came to form a gap between what banks were offering and what users came to expect, especially from the user experience perspective. Technology companies started to jump in and try to capture this opportunity. The world of fintech was born. The combination of information technology and finance has given us fintech. New technology companies have popped up all along the value chain. Some have even grown huge, such as Ant Financial, that now manages the largest money fund in the world. At the moment, there has been the emergence of many new startups and services, providing specific products along the value chain. But there has not been one that has been able to connect all the dots to deliver the full services that the universal banks can. As a consequence, the evolution in fintech has not been quite as revolutionary as hoped, as people have often opted to stay with the general universal offering of the traditional bank. This is because of the semi-monopolies that banks have had and high switching costs. Large financial institutions have in general dodged or absorbed the sort of creative destruction that, while disruptive and messy, is critical to economic vitality and the evolution of finance. But today, with a relentless revolution in information technology, the internet is evolving into a new decentralized model, where finance and technology merge in surprising new ways. With blockchains, distributed ledgers, and the new financial innovation of tokens, we can see the potential for a very different kind of financial system to the one we know today, as new forms of decentralized financial systems are being born, which are native to the internet. Historically, we have created a centralized model to finance consisting of many closed organizations, because that was the only way we could ensure trust in the system. We created trust by all of us trusting in a government, and that government outsourcing it to the nation's institutions that it regulated by ensuring they complied with requirements. The result of this, though, is that all the resources in the system have to flow through those limited sets of centralized institutions. A centralized model has advantages, but it also has disadvantages, particularly when the system becomes complex. In simpler systems, it is an effective method. But as the system becomes more complex, it results in sprawl, redundancies, compartmentalization, bottlenecks, and overly complicated processes that render the system inert and non-responsive to user needs. But just as the first generation of web technologies radically changed the face of communication through email, and the second generation changed the face of media, taking us from a world of few centralized channels and newspapers to a world where everyone had their own channel on social media and blogs, So too, the third generation web will soon offer the software solutions and connectivity to do the same to finance. The Internet of Tomorrow will be a global services infrastructure for the building of services and exchange of value. With distributed ledger technology and token economies, finance and the Internet are now converging so that the Internet has built in capabilities to record, store, and exchange value, independent from the centralized institutional architecture that we know so well. The very way that we record and account for value is changing, as a new set of information technologies provides the infrastructure for a globally distributed network of computers to maintain secure and shared records of value. This distributed technology allows us to remove a massive amount of administration and transaction cost and regulation by having an economy-wide accounting system that is secure and transparent. Such a system for coordination via distributed ledgers would have many advantages. It would drastically reduce the cost of recording, and thus make it possible for us to expand formal financial systems to the billions that are currently outside of it. The third generation web may well have native capacities to do what currently costs financial institutions billions of dollars in IT infrastructure, which means that the financial industry will not be disrupted by the fintech startups of today. It would be more accurate to say that it will be disrupted by the internet itself. This new computing infrastructure running distributed ledger technology now offers us a new way to define and quantify units of value, which are represented by digital tokens. Thus, minting currencies is an activity that is no longer restricted to banks anymore. We saw this first with Bitcoin, but now digital tokens are emerging as a more general financial instrument that can be created by anyone and used to define any unit of value. In a world of distributed ledger technology, we can now create and design tokens to meet the needs and requirements of any economy. By using programmable tokens, we can create units of value which are stored on a blockchain to represent anything that people value. This enables us to capture and define the things we value in an almost infinite number of ways and create financial systems from the ground up. We can now literally create whole monetary systems that sit on top of microeconomics, all of which are tracked securely on a blockchain. With digital tokens, we have an almost complete capacity to define any form of monetary system. We can create a finite amount of tokens, or stay adding new ones at certain intervals, define how they can be exchanged, how long they last, whether they are fungible, or how they are differentiated, how divisible the token is, etc. We can now almost design in or out any property to a financial system. The limit is just our imagination, knowledge, and design capacity. To actually build a stable and robust system requires integrating it with economy, environment, and society so that metrics are not just an account of a single subjective assessment of utility function, but reflect a more comprehensive and integrated measure of value within the multiple contexts that constitute the real world. And this is, for example, what programmable tokens now allow us to do. In a decentralized system, the centralized component is no longer present by connecting people directly and automating the coordination of processes and services on the network. This results in a model where coordination, capabilities, and control are taken out of the centralized closed organization and both embedded within the network and pushed out to the end user. In a world of distributed financial networks, people have become their own banks and own their own data by holding their own wallets. A distributed financial system is a peer-to-peer system. People own their own data and records of value and give them to others directly under their own control and discretion. People can truly be their own banks as they can also create their own credit by securitizing their own assets. Given an asset, like a house or watch, one could use it as collateral for the network to create tokens and credit them to the user's wallet. A decentralized model could see a radical jump in our capacity for financial inclusion. By redirecting the flow of resources so that they do not have to be routed, controlled, and managed by centralized institutions, we can reduce the barriers to entry and create systems that innately push outwards to the majority of the people instead of always closing inwards to the minority. With the widespread adoption of mobile computing, approximately 5 billion mobile users, we now have the potential to create truly globally distributed financial systems that reach people when and where they are with low barriers to entry. When we add distributed ledger technology and token finance on top of this telecommunication infrastructure, building protocols for people to exchange peer to peer, they can then set up their own networks for what they value and exchange it almost anywhere. These secure distributed networks strengthen interorganizational capacities. By enabling much greater trust, coordination, and interoperability across whole industries and economies, they enable the emergence of massive interorganizational and peer to peer networks where previously no formal coordination existed. This will have a very profound effect on the overall structure of our economies and financial systems, as they go from many closed organizations competing within markets to the emergence of large ecosystems of collaboration, forming complex service systems. It is these very large automated financial service networks that will be the core infrastructure of tomorrow's financial system. As the strength of these open trusted networks grows and connectivity proliferates, the centralized organization will become unbundled along many dimensions, and the product based push model of the corporations of the past will evolve into a dynamic, networked model that works to aggregate modular, on demand services around the needs of end users. Over time, those service oriented blockchain based networks will become increasingly automated through the development of smart contracts and decentralized applications. The next generation of financial services will be integrated into the everyday lives of end users. No longer a separate thing. Finance will be there when you need it, and not when you don't. Winning in this kind of world will be all about networks and protocols that connect up different automated services and integrate them around the end user's needs. As Dr. Christian Grobe puts it, observe over the next 10 years or 15 years in banking that those banks, those old banks, will survive, who are the ones that open up their IT connections to all those fintech players. Because, as I said, fintech players don't do everything well. They are just specialists for one segment. So the bank that will manage to combine them all in an open IT infrastructure, these will be the most successful. Data and analytics will play a key role in this next generation financial system. Vast financial networks running through the internet will require a much higher level of automation to enable real time, flexible, process oriented financial services. With data and analytics, finance will be able to evolve towards a much more event driven architecture. Financial institutions will be service networks, and the capacities and competitive advantage of those networks will be largely in their protocols, data, and analytics that coordinate the network and the intelligence of their people that model and design the system. For financial services to be a seamless part of people's everyday lives requires the use of unstructured data. Big data is the key to financial services becoming predictive, flexible, integrated, and context aware. Just like GPS has automated the process of getting from one place to another through algorithms running in the cloud, so too an algorithmic financial advisor will automate the process of getting from one financial place to another, so that more people can find the best route to their financial aspirations easier and faster. This will again shift the focus of the system to the end user. Their automated assistants will be making a lot of the decisions in the system. At the end of the day, these changes will work to turn the system into one that is less based around the products of the financial institutions and more centered around the various processes that the end user is trying to accomplish. The financial institution of the future will not be like that of the past. Those who manage to adapt will evolve to become networked platforms. They will be the trusted advisors to their clients' needs on the front end, but on the back end, they will be connecting a myriad of services, integrating them through analytics. The essence of the organization will be its protocols that integrate different services, and it will be in the models that go into the analytics making the operational decisions for integrating services and end user needs. It will be a world of commodity product providers integrated through massive networks running through an updated set of protocols on the third generation web. This will be a radically more efficient system than that of today. The decentralized web will commoditize financial transactions, making profit margins low. The few financial institutions of today that survive to see that world will have evolved to such an extent that they will be almost unrecognizable from what they are today. The idea that you can set up an innovation lab, with all sorts of new technologies and pour money in one end and hope to get revolutionary innovations out the other end that will ensure your survival is delusionary. It is not really about blockchains or analytics. The only thing that can ensure the possibility of existence will be changing the paradigm for the whole organization to understand that the rules of the game are changing, and they are changing very fast. As the Financial Times notes, technology is a tsunami that will radically change the face of financial services. Binance, the world's biggest cryptocurrency exchange that was non existent merely 8 months ago, is now more profitable than Deutsche Bank, one of the world's leading banks that was established 148 years ago. A startup with 200 employees overtook a banking giant with 100,000 employees within a few months of its existence. According to CNN, Binance has been able to surpass Germany's biggest bank in less than 8 months of existence. It is possible that cryptocurrency businesses take over the global finance industry in the next decade or two.